Thanks for joining us again. My name is Jake Claver. I'm the director for Digital Ascension Group. Today, we have the pleasure of Clinton Donnelly joining us. He's a CPA over there in Portugal that works with a lot of individuals here in the U.S. that have a lot of digital assets that they want to mitigate taxes on. Clinton, how are you doing?
I'm doing great. You know, I should clarify though, while I'm personally in Portugal, that's just because that's where I choose to work out of. Our company, we service Americans all over the world. In fact, a lot of our biggest crypto investors that we support are actually outside the United States. So it gives us a great location. Being here in Portugal, it's 8 hours to the west coast of the US. It's 8 hours to my clients in Australia and Japan. So I'm doing great. Our company, we have about 20 employees. All we do is crypto taxes. We do the gain calculation. We do the tax return preparation, which is always very sophisticated. And then finally, we defend people in audits before the IRS. We've done about 50 audits and 3 court cases. So a lot of success. It's been a great year so far and big changes ahead too.
Yeah, and you guys have kind of like I don't want to say an insurance product, but a subscription-based product to make sure that, people that work with you guys, you do have the capability to follow up with them and make sure that if they are audited by the IRS, that you guys defend them in that circumstance. Is that correct?
That's absolutely right. We have an innovative product. It's a subscription-based product, and it's called Tax Shield. And we repackaged it in just a powerful format for Tax Shield. It's $495. Let me tell you per year. Let me tell you how amazing this is. We actually monitor your IRS accounts at the IRS on a weekly basis. We can detect 2 to 6 months in advance when you're going to get audited by the IRS. We also send out a monthly email to you, kind of like a credit score from the bank, telling you, on 8 different categories where you stand with the IRS. And, you want to see all green check marks, but sometimes there's a red X. And if there is a red X, you give our customer service team a call, and we will dig in, find out what the issue is, and see if something needs to be done. And so that we're really having the early warning. The biggest thing is with taxes is you just don't want to have an IRS agent having your name on their dartboard. And the way to do that is to fix the problems before it comes to an auditor, so that it never gets to that level of attention and scrutiny. So that's that product. In addition, we will review your tax return after you've prepared it to see if it hits all the categories that you need for reporting crypto. If you have an issue with outstanding debt with the IRS, or if you got any sort of letter from the IRS, you can call us up. We'll talk about we'll explain what the letter means and put forward a course of action to address it if action is necessary. All that's included in the Tax Shield product. I like to think of it as, you also get a course on how to prepare your own crypto tax return if you're a do-it-yourselfer. Also, we have videos on how to calculate your crypto gain from using online tools. So it's everything you need as an investor, and even particularly a crypto investor, to protect yourself. And it's just an amazing product, and you can get it at our website. I think you're going to have it in your links.
Yep.
There. It's called Tax Shield, one word, Tax Shield. And it's just an amazing product. And there's nobody else out in the industry doing this. If you go to your accountant and he does your tax return and you think it's a great tax return, but then all of a sudden you get a letter from the IRS, everybody's blindsided. You don't have to live blind. All right. The IRS is watching you. We give you the tools to watch the IRS.
That's awesome. Yeah, I didn't realize it came with all those things. It's really great that you're able to be proactive, and you can spend a little bit of money and be proactive, or, have to deal with some more costly things later on if things do crop up. So, yeah, we'll have links in the description below for that. Make sure people reach out. I think that's a great tool for people to have, especially if they have assets in their personal name. I know that a lot of people that I work with, that's still where things sit. They haven't structured themselves inside of a business or a trust to hold their digital assets. So
when you do that, you can also set up a tax shield. If you're holding your assets in a trust or a company of some form, you can set up tax shield just for that entity as well, to be monitoring them for you. So yeah, it's good.
That's perfect. Yeah. So business, trust, whatever you might have. Is that just domestic here in the US, or if you had international businesses, would you be able to monitor those as well?
We're just watching the IRS. Now, you could be anywhere in the world, but we're just watching the IRS accounts for your
Got it.
We don't do other countries.
Okay. Makes a lot of sense. Well, that's great. The main thing that you and I wanted to run down today that I think is most interesting for the clients that might be watching this video would be the 1099 DA and the effects that that's going to have on digital assets. Do you want to give people kind of a high level of what that is and what to look out for?
Absolutely. This is the biggest change to crypto taxation since 2014. This is a radical change, and it's going to affect all crypto investors. And we're talking about it right now as the 1099 DA, which is a form you as an investor are going to get. Other people talk about as broker-dealer regulations. It's a set of about 200 pages worth of new IRS regulations that went final last month. So it's really impactful. And it basically, and let me put it in comparison, because I know a lot of your clients invest in stocks. So you probably have a brokerage account somewhere. And at the end of the year, you get a 1099B, or what's called a composite 1099. And the 1099B will list everything you sold during that year. It'll list what it was you sold, when you bought it, when you sold it, and what your cost was and what your sale price was. And finally, what was the gain? And these are lovely forms, actually, for tax purposes, because you take that form, you put in bottom line numbers into your tax return to report the total gain that you got. And, your taxes are easy. You don't have to type in all the detail. You just plug in the bottom line numbers. Well, crypto taxes are not that easy. And the 1099 DA is basically that for digital assets, which is what the IRS calls cryptos. And it's going to report all those same sort of things. So you'll get at the end of a year a statement listing, the buy and sell prices. Sell prices the buy prices if they knew what the buy prices were. But otherwise, it's just like that. Now, if you were a crypto investor that you hold all your assets on one exchange, a custodial exchange. So you buy them there, they stay there, and you sell them later at some later point in time. That 1099 DA is just going to be as beautiful a document as the 1099B is for stock investors. However, many crypto investors, as you know, Jake, not your keys, not your coin, and you want to take those off. A lot of people take their cryptos and they move them off to a private wallet. Maybe they trade them on DeFi exchanges and whatever. A lot of different platforms get involved. So the 1099 DA does not paint the complete picture for you as a tax return. So we're still going to have to go through the complexity of doing the crypto gain calculations as we have in the past. And we have to address those transactions where the brokerage, like Coinbase, knew what you bought it for and knew what you sold it for and is reporting that to the IRS. But on one level, that looks like a great thing, the 1099 DA. A lot of people are upset about it because they feel like the form is going to disclose too much information to the IRS. Now, this whole program is basically a 3-year phase in on what has to be done for implementing this. So let me break it down. And for the first year, this is 2024, there are specific things you have to do to transition into the new regime of having the 1099 DAs being issued. One of the reasons for that is they are now making it so that gain calculation always has to be done using what's called FIFO by account, first in, first out by account, rather than multi-wallet or universal, which is generally how everyone else has used it in the past. So you have to create an allocation plan to take the unused basis that you held at the end of 2024 and assign it to your inventory of actual digital assets that you have at the end of the year, of this year, right? So that's an allocation plan. I'll talk about that a little bit more. The second thing is, starting in 2025, all digital exchanges, and I'm talking US-based, centralized custodial exchanges, so not DeFi, but custodial exchanges, will start reporting to the IRS. When does that form come out? It'll come out in 2026, right? So January, February 2026, you'll get that summary form for all your trades happening in 2025. Then, starting in 2026, the exchanges have to start reporting the cost basis where they know what the cost basis is. So the IRS is going to get visibility to that. The second big change that happens starting in 2026 is that the exchanges have to report your transfers. So if you buy an asset on Coinbase, you buy, 10,000 XRP, and then you transfer that to your wallet address, there's going to be a 1099 issued that states that you took this XRP at a certain price, these number of units, and you moved it from your Coinbase wallet. It'll state that wallet number to your private ledger wallet. So on the 1099 DA, it's going to state your actual wallet address of your XRP wallet. So a lot of people are upset about that because they feel that's a lot of information for you to disclose. But over time, the ramification, I guess I'm talking a lot to you. So I let you answer the question. But on the scary side, a lot of people feel that over time, the IRS is going to get a snap. They're going to figure out what all your wallet addresses are for all the different assets that you work with. And from that, they could later reconstruct your portfolio holdings at any date and time. So,
yeah, we spoke with MasterCard earlier this year. If they want that information, they can already get it. It's not like even if you're transacting with privacy coins, they can figure that out as well. So people may be upset about these things. I think you just do it the right way, right? Like, if you're dealing in crypto, I think you should set up an entity if you want to maintain anonymity and, have some protections and benefits that provides in the full scope of the tax code that you can work with them on to make sure that they're mitigating the taxes. I would just set up entities that you're using in order to purchase these assets, and invest with them and do all the things that you just discussed there, so that, that wallet address is owned by the LLC or the corporation or the trust. And then, if there does come a point where the IRS is reviewing that, or it's on a public blockchain and those addresses become publicly available as listed under something, you don't want you don't want your personal name out there. They already have that on like XRP scan. You can put in the exchanges and it'll pull up their wallet addresses as, their wallet 1, 2, 3, 4, 5, however many they have. I think at some point in the future, it's likely that because these are public blockchains, there will be names associated with wallets. And at that point,
you're right. The challenge the IRS has is they can get that information, but then they get into
rights.
What manner are they obtaining the information, and did they get it? Did they violate your rights in how they went and researched to get that information? There's certain restrictions that they have. So now they get around that because now it's being reported to them. So they're entitled to own that information. I will give you a very interesting court case that would be very relevant to your listeners. And this has to do with the indictment of Roger Ver, who oftentimes was known as the Bitcoin Jesus. He was a very early investor and promoter of Bitcoin. In 2014, he renounced his citizenship. And when you renounce your citizenship, if your total assets is in excess of $2 million, your net worth is over $2 million, then you have to basically, it's called an exit tax, but you basically pay 100%. The unrealized capital gain on your assets at the time that you renounce. All right. So you kind of you're paying those taxes that you would pay if you had sold everything that day. Now, he also, so when he did his tax return, he claimed that he didn't have any Bitcoin, which he did. He had in the neighborhood of 150,000 Bitcoin. And he also had 2 companies that he owned where he held a lot of Bitcoin. And this becomes important. These were both LLCs in his own name. So he later in 2017, 2018, he transferred Bitcoin from his U.S. companies to his private wallets. That's basically a distribution. And even though he's not a U.S. citizen, that distribution would be taxable back to those companies that did the distribution. And he's still responsible for that, because that's basically, he was still a U.S. citizen when he received that. Now, I won't get into the complexities of it, but he would oblige to pay tax on it. Well, they were able to identify his wallets, and they use a methodology called cluster affinity, where they look at the different wallet addresses, even the alias wallet addresses on Bitcoin, and to say, oh, these are all his wallet addresses. And from that, they were able to go back and reconstruct the portfolio of coins he had back when he renounced in 2014. And they could prove, first, that in fact, he did personally own Bitcoin, which was not reported on his expatriation tax forms. And secondly, that his companies had those Bitcoins at that date as well, right? So those were assets that he owned through a disregarded entity, the LLC. And then I think it was actually, these are actually S corps. So he then, when he distributed them, he received that income. He was taxable. So they charged him with this crime, and he was arrested in Spain, and he owes roughly $42 million in back taxes. But this guy has a couple 100,000 Bitcoin, so it's a drop in the bucket. But by trying to escape it early, he should have, he actually created a bigger problem in his life.
Yeah,
so
if it had been 2014, he might have been worth, maybe it was the 40 million then, right? You just pay liquidate a portion, pay the taxes that are owed at that point, or borrow. I don't know if you could have borrowed against your Bitcoin at that point to pay the taxes, but
well, certainly. I mean, in 2014, what was the price of Bitcoin? Like $100, $200, something like that. And come 2019, even in a bull market, he could have sold a lot of Bitcoin, paid off his past obligations, and he wouldn't be rotting in a Spanish prison right now waiting extradition. So it highlights one problem where a lot of people feel like they can, the IRS doesn't know about it. I can get away. I get out of the country. Nobody knows me, but they eventually will. When there's a fraudulent tax return, there's no statute of limitations on them coming after you. So they have all the time in the world, and they can reconstruct things. And there are tax treaties with other countries where the IRS can still come after its former citizens up to 10 years afterwards to get redress. And they can also pick you up on airports and stuff. I mean, it's just, the bottom line is it's never a smart move to be stiffing the IRS.
No. Yeah, you just pay or use the tax code to be able to mitigate the tax implications, right?
Yes, exactly.
They give you lots of ways to be able to do that, so might as well just take advantage of them, and then I have people that are outside the US that ask if they should form companies here, and I'm like, if you don't have an affiliation with the US and you don't plan on living here, I would just form it in other locales. Portugal's a great place where you live. There's a lot of other great places there in Europe, Nevis, Jordan, Switzerland, that are better tax advantage locations, Dubai. So, no, it's very interesting on the form that people are going to have to be dealing with. And I think that just lends itself to the maturation of the space. I think a lot of these exchanges will end up having to be registered as broker-dealers. There will likely be securities contracts that are being traded. If they're participating in DeFi, lending, staking, AMMs, or liquidity pools, a lot of those are going to have to be structured products, and the risks are going to have to be disclosed to investors, and people to participate will likely, have to be accredited at certain points. I'm hopeful that some of that regulation changes, and I also think that a lot of these exchanges will potentially get purchased by large investment banks or other providers that want to offer these services that don't currently have that service, right? What are your thoughts there? Do you think regs move in and they require registration as broker dealers for a lot of the exchanges?
Well, I think all the U.S. based ones, and you'd be surprised. There's probably up into the number of 40 or more U.S. exchanges that have to comply with these broker dealer regs. Now, that's broker dealer just from a tax point of view, and there's also the SEC, and I won't even get into that. But in addition, the law gives the IRS the ability to regulate other exchanges that aren't U.S. based. So, they're working through the OECD. It's called the CARF initiative, the Crypto Asset Reporting Framework, where they'll get information from other countries. So, for example, Binance is based in Malta. There'll be an exchange of information from Binance via the CARF agreement to the U.S. So over time, not right away, they'll get this information. So we should always live and trade as though all things will be known. I do believe that, to your point, that as the uh, SEC gives more clarity in terms of how brokerages and crypto exchanges can operate, then I think there will be a mass grab to buy up. I expect Coinbase and Kraken and all these other guys will be bought up. I think exchanges like, I understand Gemini just decided to leave Canada. I don't know if they're still in the US, but they don't want to be a part of this regulatory framework. I think they're just shooting themselves in the foot. Regulation is good. Everybody loves regulation. There's more volume in regulation. It will cost more to trade on a regulated exchange, but you're going to have more business. It compensates for it. I mean, and that brokerages have been doing this all along. So I think it's a wrong move to be dealing with an exchange that's fleeing the U.S. And you can't flee for long. Look at Binance. I mean, they weren't even operating in the U.S. except they had a separate exchange, but the entire Binance organization got pulled over the coals. They threw CZ into prison. Rest assured, they're giving the U.S. all trade information for all U.S. people that were trading on Binance International. So, when they broke Binance, it was equivalent to when the U.S. broke Swiss bank secrecy. When the FATCA laws, when they broke the Swiss bank secrecy, all the other banks caved to the FATCA reporting obligations, and that's pretty much what you just saw with Binance. They have now been broken, and all the other exchanges will comply or be crushed.
Yeah, or bought up, and people will roll out and let somebody else deal with the mess that they've created.
This very well may be the case. It's going to be the exit strategy pretty soon for most of those exchanges.
I think so. There's gonna be a lot of people that step in and buy up hot deals, which is good. Like I said, we want, to your point, if we do have regulation here in the space that provides more liquidity, more volume, more adoption, legitimacy, transparency, which it's funny to me that, everybody's like, it's immutable, it's transparent, it's great. And then they also want to hide their own stuff and have the anonymity. So,
well, I'll tell you, there's a really big, the massive thing that really should come away with your listeners come away with regarding this whole 1099 DA program is, as a it's a multi-year phase in. What do you need to do this year to comply or protect yourself? And there's two things that need to be done, and let me explain why. Well, the two things need to be done is you need to adopt an allocation plan, and secondly, you need to have a complete inventory of your existing coins at the end of the year. So here's what happens. They're changing how we're doing basis calculation. How do we calculate how much you paid for buying a coin? They're changing that calculation because all crypto traders, they buy them, they move them to this wallet, that wallet, they break them apart in groups like that, and they swap this one for that one, and you really have a difficult time tracing it, which is why you use services like CoinTracker, TokenTax, Zero, ZenLedger, and these services to help calculate what was my gain. And you could use a variety of methods for calculating gain. There are two flavors. One is, do I use first in, first out, FIFO, last in, first out, LIFO, or the most popular, HIFO, highest in, first out. Secondly, when I do the first in, first out calculation, do I look just at any coins that are in that wallet, or do I look at all the wallets I have and cherry pick, the one that I want to take from it? And that latter description is how all those services operate. Well, we call that a multi-wallet or universal approach. That's going away. It all has to be by account, and it has to be done FIFO. What does that mean? When I sell a coin, when I sell a particular coin or token, I have to sell the one that was in that wallet at the time, and whatever the cost basis of that was. Now, that might seem obvious, but that wasn't the regulations. That was not how the guidance was issued back in 2017. We had a lot more latitude, and everybody took advantage of it. But now that we're changing, there's a total disconnect because, in a sense, we don't know exactly what those coins cost because it's all been shuffled around. So what we have to do is we have to get an inventory of the unused cost basis at the end of the year, right? What hasn't been sold, and then we need to map that cost basis against your actual inventory of coins at the end of the year. And that mapping then we're establishing the new cost basis for those coins. If you don't do this, well, first of all, by doing this, you protect it so you're not going to be overtaxed. If you don't do this, when the IRS does your gain calculation, they're going to use FIFO by account and they're going to go all the way back into time. They don't care how you used to do it. So we have a safe harbor. If you don't take advantage of the safe harbor, you will be paying duplicate tax. And it can get to be a pretty significant number. We've had a couple scenarios where we tried this out. In certain situations, this could be a staggeringly high number. Plus, you'll be subject to penalties and interest. So it's very, very important you do two things. First of all, get a allocation plan. Secondly, get the inventory at the end of the year. We've made it easy for you at cryptotaxaudit.com/1099. You can go there and we already have an allocation plan that you can adopt. It's a rules-based allocation. It's called a safe harbor allocation plan. And you sign up for it. When you sign up for it, what you're doing is you're actually doing an electronic signature, which gives you a date stamp that we can later show to the IRS, if audited, that it was adopted before December 31st, 2024, which is required by this procedure. And then we also, when you sign up, we get your email and we'll send you instructions on how to do an inventory at the end of the year. And we'll be reminding you about the importance of doing this and how to capture that information for your books and records. So you need to do these two things and we're going to help you. So don't worry about all the rest of the stuff that's happening in years 25 and 26, but do these two things. And even if you don't like the allocation plan, you want to do a different one later, it's no problem. At least you got one in the pocket if you need to show it to the IRS. And that's totally free. And we're giving to the entire crypto community. And we have all the information about what else is happening in the regs and stuff. If you want to read the FAQ, you can really bore yourself to tears. And it's extremely complex, to be honest. But all you need to do is go out and really just do one thing: sign up for our allocation plan, the safe harbor allocation plan, and then we'll send you emails on what to do next after that. So, and if you don't do this by December 31st, 2024, the door's shut. So there's no recoveries, because in an audit, you're going to have to prove that you had this before that date. So we got it all taken care of for you, but you got to act. You have to sign up.
That's great. So for our clients, this actually makes a lot of sense. So you may have, I had a bunch of wallets before I moved my assets into institutional custody, and they would all have had different cost basis associated with those when those were purchased and then moved into those wallets. And then depending on when and if I sold those, it would be a problem later on. But since I've consolidated those to one wallet address that has an average cost basis moving forward inside institutional custody with us, it does what effectively you mentioned there, right? So now, moving forward, we understand the cost basis. That's the aggregate total of those coins that have all been placed in institutional custody, and any sales or transactions on the other side of that would be associated from that cost basis, which is the average instead of what was appropriated at the time to those previous wallets. Is that kind of the gist of it?
Well, I would suggest that because your clients own things not just in their own name, but in the names of various institutional accounts, that they should also adopt a safe harbor plan for each one of those separate entities. When you sign it, you go, Jake Claver, the Claver plan, so that you can indicate if it's for an institution. You should adopt one for every single one of them. And at the end of the year, do the inventory for all of those. Now, clearly institutional is going to be a little bit easier because it's all in one place, but the cost basis has to be established, and there's no downside for doing this allocation plan. So I just think it's going to be safer for you. There's just everybody should do it for all their entities.
And when we have clients move things into an LLC or a trust, the date that they move that in there, they have a notarized contribution page for whatever it was that would show the cost at which assets were transferred in there. And we're looking to that, because some people have a hard time determining what their cost basis was. So we have something that we can point to at a point in time and say, this is what it was at this point. Moving forward, that's what we would use.
So now this is an institutional account. It's not a single member LLC owned by the investor, is it? It's a separate custodial entity, right?
Sometimes it is. So,
okay.
There's transfer of cost basis and time held. There's no step up or anything that happens at that point. It's not a taxable event for the contribution because you're exchanging those assets for the equity in the business. So they're just moved in there.
Okay.
Sometimes they're a disregarded entity. And if you do it that way and you were to pass away, your heirs would get the step up in basis, right? But if it is taxes and S corp, there's no step up upon death. The basis would transfer to the new owners in that circumstance. So
Right. Where it's an LLC, you still have it's disregarded by the IRS. So those assets can be calculated along with the assets that you have in your personal holding for calculating cost basis purposes. So, obviously there's like a variety of doors into your institutional structures, and we have to look at each one of those. The key, if there is actually a change of ownership, so there actually would be a genuine change of cost basis, well, then that's a great document of that.
yeah.
That's actually the cost basis of those coins. So, and I would imagine that your institutional accounts, that's basically a single account, if you will, from an IRS
Yep.
point of view, which
Correct.
really makes things immensely simpler. I mean, I think for those investors that are holding their assets institutionally in a custodial account like that, you're going to get a 1099 DA. That's going to be a beautiful thing.
Yeah.
And it's going to
Super
make
simple.
a whole lot of simplicity for you.
Yeah. We work with Anchorage currently, and they'll be providing our clients that at the end of the year for any transactions that happen on their platform. And we have the cost basis, again, when the assets were moved into the entity, we'll point to that for the IRS. So, yeah, I think
That'd be good.
people that haven't done these things or potentially in for some problems in the future. But again, I think, a couple years from now, I think it'll be normal to hold your digital assets in institutional custody with providers. I think there's going to be a large variety of people that open up these services. You saw the SEC give BNY Mellon the green light to be able to do that and hold them off balance sheet. And not have to deal with 121, Psalm 121. I think that they'll probably just remove that rule eventually, and a lot of these other custodians will start accepting and holding crypto aside from just BTC and providing those services. We're just early to the market with what we're providing. So
yeah, I agree. I mean, we have a lot of massive clients, and they're not really comfortable holding, tens of millions of assets on a ledger in their desk drawer, and they're just not real comfortable with that. And they are looking for a custodial solution if there's a custodial player out there that they feel is
adequate,
systemically large enough that they're not going to fail and lose their their crypto investments.
So Anchorage has segregated that out. It's bankruptcy remote. It's completely separate of their other business. So if they were to go bankrupt on the exchange side or even on the institutional custody side, there would be another trust bank that would step in and be the custodian over those assets, and there's non-recourse. So those assets would never be up as collateral for that default or the bankruptcy on their side. So there's no way that they could, and our clients are signers on the account, so they couldn't be removed, right? So it makes it super secure, and you have the insurance on there as well. There's $100 million in crime insurance on the assets. So yeah, I don't know of anybody else that's more qualified here in the U.S. They're a federally chartered bank, and the other benefit when they got that passed was they can actually provide the staking services because they migrated from a Wyoming state bank to a federally chartered bank, and the SEC, when they provided them with that, they didn't remove their ability to stake, so we can do that with no issues.
Very good.
So,
well, it's an attractive thing. I mean, when you start holding assets in excess of $2 million, you really need to start thinking about a more secure way to be storing your assets for inheritance purposes, for just safeguarding purposes. And I think, what you guys are doing is amazing.
thank you. Appreciate that. We're excited to have a product that we can bring to people. We're the first ever SEC registered RIA that has as many clients as we do, and excited to be able to provide these services. So anyway, I want to say thank you for your time and all of your knowledge and expertise that you provided the listeners. Just let people know, how they can find you, how they can reach out and interact with all the services that you provide, Clint.
Sure. Well, a couple of things. We're CryptoTaxAudit.com, and that's exactly what we do, right? We're crypto, we do tax, we do audits. We also they can reach us at we can look at our safe
links.
harbor allocation plan going to cryptotaxaudit.com/1099. And as we mentioned at the very beginning, the whole monitoring service, the watch your back type of service called Tax Shield. You can go to cryptotaxaudit.com/tax shield. I think the links are right there in the video notes. And so love to talk to people. And especially I didn't tout our horn, but we're now wrapping up our third audit with the IRS that has gone to tax court. The first one, the IRS wanted 1.5 million. And we were going to tax court. We worked and negotiated with their technical experts, and they eventually closed the case with no charge at all. They just dropped it because we proved that the client didn't owe that extra amount. Another case, which was a like-kind exchange case for crypto, the IRS settled for $6,000 on that. So that's basically a victory for us, a very significant victory. And we have another court case that we're almost finished with, where they are looking for $2 million from the client. And they're now at a point where they're about to settle for nothing. So, close the audit. Actually, we're going to get a refund out of it. So, yeah, we are the specialists, and we've done 50 other audits for people who have been audited on their crypto. So if you get out on your crypto, we are the people to go to. That's why we're the leaders in our space.
Love that.
So,
brother.
Pleasure being on your show.
Yes, sir. Appreciate you being here. And thank you all for watching, and we will see y'all on the next one.